Hello, and welcome to another episode of the Rich by REIT podcast. Thank you for joining us today. My name is Diana Wrona, and I'm the Director of Private Capital Markets here at Lankin, and I'm joined by Ray, our President of Private Capital Markets. It's been an eventful year, so today we'll unpack real estate investing over the past few years. When you think about real estate, it is long-term. So Ray, what trends have you seen emerge that really provide, consistent outlook so far?
Sure. So if we look at real estate trends thus far for 2025, there's a number of things that are happening. So, in terms of commercial activity, institutional activity, it's expected that there'll be about $50 billion of transactions that take place in that space. When you unpack that a bit further, if you look at Q1, you look at Q2, approximately 51% or more than half of the transaction volume took place in multi-res, and it took place in the industrial asset classes. So that's, I think that lends say, hey, look, those two asset classes had been performing well in this economic market. The condo market, look, there's so much news and information on the condo market. I don't really want to beat this one up, but I'll just make a few points on that one. Number one is that there is an oversupply situation, and this has simply been created by having a number of vacant units and then the marriage of new units coming online. So newly developed units are coming online, and it's creating an oversupply, which is putting a downward pressure on rent. So we're seeing some softening in the rental rates in the condo market and just generally in the rental space as a whole. It's geographic dependent as well, but generally speaking, it's more impacted in the condo space. The other thing that we're seeing is new condo projects coming to a halt. So where developers have land secured, they are unable to sell units, so they have come to the decision that they will be halting the project altogether. And the third piece that we're seeing in the condo space is the flight to condo development going to multi-res development. So there's a number of applications. So if a project has been canceled, some developers are attempting to make multi-res in that spot. The other thing I'll share is we're starting to see the institutional capital start to wake up a little bit and go from the dry powder format or cash format coming back to real estate. And I think we'll start to see a little bit more of that taking place in 2026. And that's really pensions and endowments and large institutional players coming back with capital to hard assets. And that would be fully supported by banks having very healthy balance sheets. Banks are in a very, very favorable position for lending. Just based on certain commercial terms for different asset classes.
Yeah, thanks, Ray. I think that's a great high-level overview of the trends that we've been seeing emerge in real estate investing in general. But you mentioned multifamily. I think that this has been a strong asset class that has provided stability throughout the year amidst all of the uncertainty and moves in the market. Really, it's the essential need for housing, right? Everyone needs a place to live, so the necessity of this asset class is still going to prevail. But more geographic locations are more favorable than others. So why don't we pivot and talk a little bit about, specific to multifamily, what target markets are we seeing emerge?
Yeah, so great question. I like, there's certain markets that I really like. There's a lot of great markets, mind you, in Canada, primary markets or secondary markets. There's markets that are sort of more dependent on sort of economic factors, but I'll hone in on five. And one of the number one cities that I really like as a market is Hamilton for multi-res. When you take a look at Hamilton as a market, it is the 9th largest city in Canada. It's, I believe, by percentage, it has 5% of Ontario's population. And when you take a look at the number of renters in this market, 1 out of 3 are renting in this market. So 33%. And then the other thing I'll say is when you look at the actual affordability of Hamilton in terms of a 2-bedroom, you're looking at an average of about $1,700. So it's quite affordable to live in that market. And it is considered as a part of the extension of Greater Toronto area, or GTAH, as it was a coin back in sort of 2018, 2019. When you take a look at sort of who's living in Hamilton or sort of that demographic, very strong demographic of students, given the university, given some of the career colleges in trade space, but also there's a lot of medical as well. So whether it's medical students or sort of just medical staff, because of the number of specialized hospitals that are in that city. The other thing that I'll say is Hamilton is a very well-built city, and there's very limited new supply coming to this market. And this really creates that demand relative to the assets that are there, putting an upward pressure on that rental market. Because when you have no new assets coming in and now you're dependent on the assets that are existing, it does support a stronger valuation and stronger market rents in that marketplace. The second city I like is Brampton. Why do I like Brampton? Look, Brampton is, it's very close to, so Brampton, Ontario, very close to the airport, about 10, 15 minutes from the airport, the Toronto Pearson Airport. It is the fastest growing city by population in Canada, period. Over 800,000 residents live in Brampton. That is expected to grow to over 1 million in the next 15 years, if not sooner than that. And over 25% of that market is renting. So 1 out of every 4. When you take a look at the economics of Brampton, very strong manufacturing and industrial employment opportunities exist in Brampton. So if you're living in Brampton, there's a very good likelihood that you can also be just working in Brampton as well.
Yeah.
And like Hamilton, there's also very limited new rental coming. There has been some condo development in the Brampton market, but very limited new rental supply coming into that marketplace. In terms of investment with Brampton, you're seeing the municipality, provincial government putting a lot of money into infrastructure through a new light rail transit. You're seeing a new hospital coming into Brampton, so a second major hospital, as well as there's a number of multinational head offices that exist in that market. I also like Mississauga. So Mississauga, like Brampton, they're sort of a part of the Peel region in Ontario. Mississauga, very strong city, very well developed, 800,000 residents living there. About 30% of that market is renting. It's a very mature city, so there's very little landmass left. Mississauga was started to get developed up in the 80s and the 90s and into the early 2000s, until to the point today where there really isn't anything else to develop in that Mississauga market. So there's very limited land supply in that market. We're seeing a lot of newcomers and young workforce living in Mississauga and coming to Mississauga, given the proximity to Toronto, given the proximity to employment opportunities, and given the proximity to transportation. So major highways and things of that nature. Like Brampton, a lot of multinational head offices do exist in that market. There has been a number of condo projects coming up in the Mississauga market, but keep in mind that condos and multi-res apartments, depending on the marketplace, tend not to or cannot, in some situations, compete up against one another. And that's just simply based on the economics of market rent. Where a condo may be demanding, upwards of $2,000 for a 1-bedroom, in many markets you can get something of a similar nature for $1,500 or less.
Yeah.
I also like Edmonton, and I also like Calgary. Now we're sort of pivoting to another province altogether. When you take a look at Edmonton, huge city. There's over 1 million people living in that city. There's over 37% of that market that is renting. And when you look at Edmonton as a city, the market rents, generally speaking, are more affordable given the economics and geographic location of Edmonton. But there's also been a strong absorption of new units coming into the Edmonton market, meaning that any new supply coming into that market is quickly absorbed, and that's because of the net migration, and we'll unpack that in just a minute. Calgary, another strong market, over 1.4 million Canadians living in the greater market of Calgary. About 30% is the rental. So 30-70 split there, so almost 1 in 3. And then what I'll say there is that this is actually the tightest market in all of Alberta. And this has really led to sort of, rent versus income ratio is very appealing here. And just that net migration that's taking place to the province of Alberta, and that's being led by newcomers, and that's also being really supported by interprovincial migration.
Yeah, no, I think those are all great points. And I specifically like that you mentioned, condos being primarily in the downtown core, so the stronger markets and more stable markets being, mainly in the GTA and Ontario, but also the migration aspect into Alberta for lower cost of living. They also have the strength of the labor force there with the oil and gas industry. So I completely agree with you with those picks. When we think about overall demand in the multifamily space, I think it's important to see trends that external factors like population growth and inflation are playing in the space. We see the average age of a first-time home buyer across Canada now increased to 36 years old. And in Ontario specifically, it's now 40. So that's quite a significant number, and it's been increasing towards that. So we're seeing that consistent rental demand in multifamily, and a lot of the areas that you mentioned are in GTA and Ontario, which have that significant demand as well. when we think about multifamily and that consistent demand, you would think that there are a lot of real estate operators in this space. So why don't we touch on that a bit and strategies that we see?
No, that's an interesting question, because there's a misconception that there's a lot of real estate operators in Canada, but the reality is in the institutional space, there's actually not that many. And when you actually take a look at the different operators that are in Canada specifically, they all have a different strategy. And maybe I can unpack how that can look different amongst the different operators.
Yeah.
The first thing what we can talk about is asset class differentiation. So certain operators may like certain asset classes. At Lankin, we like multi-res. This is the space that we deal in. There's other operators that deal in industrial. There's commercial, so there's retail. There is self-storage. There's development. There's hospitality. So there's a number of asset classes that operators are involved in, and not everyone is involved in all of these different asset classes. So that's the first thing that I'll touch on. The second thing is when you take a look at the business model of these operators, business models can look very different from the types of assets now that you're buying, right? So we talked about asset classes, and within these classes, there's a classification of there's core plus, there's development, there's value add, there's short term, there's long term. So there's very different business models that operators will adopt. The other piece I'll talk about is vertical integration. Yeah. And vertical integration really lends to, hey, look, what is your business operating model? And what does that ecosystem look like? Are you in in-house asset management? Are you in-house investment management? Are you in-house property management? Now, when you sort of put these three things together and you have them all in-house, you now have the ability to manage your own assets in a far more efficient manner than relying on third parties who may be managing assets for a number of operators and may not be prioritizing your assets. So that's another thing to look at, is vertical integration. The other piece I'll share is capital structure. So different operators may have their equity coming in from different sources. And those sources can look like institutional capital. It could be private equity. You could take a look at family office. Then there's, of course, retail. There's a lot of individual investors that are also involved in the space. And lastly, there could also be joint ventures. Now, when you sort of take a look at all these, the capital stack, as we call it, this helps determine the ownership structure of the fund, but it also helps determine the fund structure, what can be an open-ended fund or a closed-ended fund. Yeah,
we covered a lot there. So what makes Lankin different?
Lankin is specialized in multi-res assets, and Lankin is also a vertically integrated organization. So I just touched on that. We talk about that integration of property management, investment management, and asset management. We have the ability to get to our assets a lot quicker than relying on third parties, which means that we can more efficiently manage the assets, but we can also drive value out of the assets a lot quicker than most of our peers. Yeah. The other thing I'd like to share on Lankin is we are active managers. What I mean by active managers, I don't mean that we're buying and selling. What I mean is that we actively manage our assets. And really that's through a number of NOI strategies, or net operating income strategies, that support greater valuation or greater growth on our assets, so we can deploy a higher return profile for our investors. The other thing I always share is that, look, our assets that we acquire and that we own are 100% Canadian institutional grade assets. Yeah. So we today are at $2 billion in assets under management, and that is $2 billion of Canadian assets. So very proud of that.
I think that's all really great, and that's what I really appreciate about Lankin, using critical thinking to drive returns from end to end while continuing to mitigate risk. So let's talk about Lankin's Apartment REIT for a bit, because I think this is a great opportunity that a lot of people are looking at currently. And really, it's acquiring large-scale multifamily residential assets in these core rental markets that we discussed. Currently, there's around $500 million sitting in the portfolio, although it's growing very quickly. And what a lot of people are enjoying is the passive nature of it. So you're still getting access to monthly cash flow and value appreciation of the assets as if you were to own it yourself. I have an investor currently that has invested into the apartment REIT, but one of the things that we were discussing was he actually enjoyed the active management of his real estate properties. But one thing that he noticed was they were all backed by single family. So diversifying into the scale of the multifamily assets that we provide was one driver for long-term growth and stability within his portfolio. Giving him a little more time also, because 8+ assets without having an external property management team is quite time consuming as you're preparing for retirement as well. You do want to make sure you have that cash flow and you do have a little bit more time on your hands for things that you enjoy. But lastly, the last item he couldn't really get over, which we eventually did, was control. He liked being able to manage the assets, but also the tax efficiencies that came with it, being able to write off against the properties that you own. But then we touched on the LP structure of the apartment REIT that's available as well, and having that expense flow through. So maybe let's break that down a bit more and go into dive deeper into the tax efficiencies.
Yeah, sure. Let's do that. I think, with your investor, I think that's a full-time job managing a property.
Yeah.
It's not easy. So on the tax efficiency side, so let's talk about the LP, but let's start maybe with capital gains. So when an investor acquires the fund, they buy at whatever the valuation is today, and whenever they decide to liquidate the fund, how many ever years that may be out, that would be a capital gain trigger. So based on the value of the unit price from buying it today to selling it whenever, call it 3, 5, 6, 7 years, whatever, that would be considered a capital gain. So that is very efficient. It's not business income, it's not employment income, it's a capital gain.
Yeah.
So that's the first piece. The second piece is the Lankin Apartment REIT has a cash distribution. So there's a monthly distribution that investors receive. They can take it to their bank account. They can also reinvest it at a 2% discount. Now, those distributions historically and to date have been 100% return of capital. And that simply means that is fully tax deferred. There's no taxes payable in the next year on that one. It's tax deferred. And the third piece, what you're unpacking is the LP. So the apartment REIT, yes, it is available in the trust series, but is also available in the LP. LP is simply a limited partnership. And this is available for non-registered, and this is available for accredited or permitted investors. And really what this enables the investors to do is get the benefit of a tax loss flow through. And that's achieved by the fund allocating the expenses directly to the LP level, so that they get flowed through to the LP unit holders at a pro rata of the number of units that they own, and that creates a tax loss, which gives those investors what we call a T5013A tax loss slip every year, which investors can take that tax loss slip. They can take to their accountant when they're doing their taxes, and that becomes a write-off against capital gains, dividend income, employment income, or a business income. So one of the four. So this all lends to a stronger return profile. But when we talk about sort of the return profile of the fund, this tax efficiency piece sits on top of the fund. So I find that a lot of investors and advisors and portfolios have really been benefiting from the LP because of that tax loss that is shared with them.
Yeah, I think those are that's definitely an added benefit when you're looking at investments, especially for tax efficiencies. So we've done a lot of looking back, and we've uncovered a lot of trends and strategies. So what are we looking at in 2026?
Look, I think there's a lot that can happen in 2026. If I had a bit of a crystal ball and just based on sort of, what I sort of research and, the economists that I listen to, I think the first thing is we'll start to see a certain level of stabilization in the real estate market. And that would be sort of supported by the lower interest rate environment. So I think we're going to start to see some benefit of the 300 basis point drop that we've seen over the last 18 months to 2 years. And that should support a higher level of demand, not only for institutional assets, but generally the real estate market itself. We should probably, generally the way it starts is there's a bit of an inventory cleanup. Yeah. And then you start to see somewhat of a recovery. I think it will be a slow recovery, but I certainly think that what you'll see institutional capital returning back to hard assets. And once institutional capital returns, I think that fully supports cap rates or cap rate compression. Cap rate compression simply is driven by demand, is driven by lower interest rates, and that's just a higher valuation on assets, which is very healthy for the real estate market. I think I touched on this earlier as well, that banks are sitting on very healthy balance sheets right now, which are very ripe for lending. And I think they're welcoming a lot of institutional and individual investors or just Canadians to come and start to borrow again to put back into hard assets in real estate. The second thing I'll touch on, and actually you touched on it a little bit as well, this is sort of passive investing, is we're seeing a lot of new investments coming to private alternatives. And that's really at the expense of investors no longer wanting to be landlords. Like the example that you shared, in most cases, anyone entering in this market as a landlord for an investment property is likely going to be cash flow negative. And they should probably expect stagnant growth on that. So it may not be the right time to be getting back into that market. So we're seeing a lot of that capital coming into passive investments like Lankin, where you're no longer the landlord, you're passively enjoying your investment, but you also have that growth upside. At Lankin, lastly, we have a very strong pipeline of assets that we're looking at, both under contract and under pipeline. And I think what you'll continue to see from us is with the assets that we already own, we will continue to drive value through those assets with our active management strategy.
Yeah, those are all really great points. And I think the main takeaway here is that even though there was a lot of uncertainty and things to unpack in the past year, the worst thing to do is to stay stagnant. It's best to see what has consistently been stable and predictable over the past years, which I think you've done a great job in covering. So I appreciate your insights, Ray. And I think that concludes this episode. So thank you for spending time going over the past year of real estate investments and looking forward to 2026 with us. If you have any questions, you can reach out to us through inquiry@lankin.com or visit our website, www.lankin.com. And you'll be connected with one of our dealing representatives that would be more than happy to answer any questions that you have. I also have an upcoming webinar in December, so keep an eye on your inboxes for registration to be opening on that. Otherwise, thanks again for joining us on another episode of Rich by REIT. Enjoy your evening.